Welcome to The Explainer. Today, we are diving deep into a topic that touches pretty much every single ringgit you earn, Malaysian taxes. We're going to break down exactly how the system sees you, whether you're an employee, a partner in a business, or a company founder. Let's get right into it.
So, just for a second, think about where you are right now. Are you drawing a salary, kicking off a new business with a friend, or maybe you're building a full-on corporate empire? Whichever it is, the structure you choose completely defines how you're taxed. The Malaysian system looks at each of these very differently. And, getting that difference is absolutely key.
Okay, here's what we're going to cover. First, we'll hit the absolute basics of the system. Then, we'll look at the rules for individuals, then partnerships, and finally, companies. And at the end, we'll pull it all back together so you can really see which one makes the most sense for you.
Right. First things first. Before we can figure out how you're taxed, we've got to take a quick look at the system that's running the whole show.
So in Malaysia, the Ministry of Finance sets the big policies. And the Inland Revenue Board, LHDN, is the one that makes it all happen. But here's the part that really matters to you. It's a self-assessment system. That pretty much puts the ball right in your court. It means it's on you to figure out your income, file your return correctly, and pay the right amount of tax on time.
Let's start with the most common one, the one that probably applies to most of us, the individual. This is really the building block for understanding everything else.
An individual taxpayer is, basically anyone earning money in Malaysia. It could be from your 9-to-5 job, a side business, rental income, you name it. The system is progressive, which is just a fancy way of saying that the more you earn, the higher your tax rate gets. It starts at 0 and climbs in steps all the way up to 30%.
So how do they actually land on the final number you owe? It's kind of like a 4-step funnel. First, they take all your income from every source and lump it together. That's your gross income. Then, they let you subtract any allowable business expenses, which gives you adjusted income. After that, they add up all your income streams into one pile, and then, this is the good part, you get to subtract your personal reliefs for things like family, medical, or lifestyle spending. Whatever's left at the very bottom of that funnel is your chargeable income. That's the magic number that your tax rate gets applied.
Okay, this next part is so important to get right. A tax relief and a tax rebate sound similar, but they are totally different things. A relief shrinks the pile of money that you're taxed on. But a rebate? That's way more powerful. It's a direct ringgit-for-ringgit discount off your final tax bill. It's like a coupon you hand over at the very end.
And this is where we see one of the most powerful features for Muslim taxpayers in Malaysia. Your zakat payment isn't just a deduction. No, it's a direct tax rebate. That means if you owe, say, 1,000 ringgit in tax and you've paid 1,000 ringgit in zakat, your tax bill can literally become 0. It's an incredibly effective tool for managing your final tax liability.
All right, so that's you as an individual. But what happens when you team up with someone? Let's look at the partnership structure and see how that changes the game.
Here is the single most important thing to remember about a partnership. The business entity itself pays 0, zilch, no income tax. Now that might sound a little weird, but it makes perfect sense once you see how the income is handled.
So here's how it works. The partnership just files one form, Form P. This is purely for information. It tells HLDN, hey, the business made this much money, and here's how we split it between the partners. The profit then flows through the partnership, kind of like water through a pipe, directly into the hands of each partner. From there, each partner just adds their share of that profit to their personal income and gets taxed as an individual, using those same progressive rates we just talked about.
Now, the partnership model is great because it's simple, but it has its limits. What happens when your business starts to get bigger and you need more protection, a more formal identity? Well, that leads us right into our third and final category.
Now we're getting into the big leagues, the Sendirian Berhad, or Berhad. This is the most formal business structure. And in the eyes of the law, and more importantly, LHDN, a company is its own person, and that is the absolute game changer.
A company is a separate legal entity. It is completely distinct from you, the owner. This means the company is the one that's considered the taxpayer.
The company earns the profit, the company calculates its own tax, and the company pays LHDN directly from its own bank account.
And unlike the progressive steps for individuals, companies get a much simpler deal. It's a single flat rate, and that rate is 24%.
Now, while 24% is the standard, the government does give a pretty nice break to smaller businesses. If your company is an SME with a paid-up capital of 2.5 million ringgit or less, you actually get a lower, tiered rate on your first 600,000 ringgit of profit. This makes it a lot more tax-friendly for businesses that are still growing.
Okay, let's circle back to Zakat one last time, because for a company, the rules are completely different, and you have to know this. For you as an individual, remember, Zakat is a powerful rebate off your final tax bill. But for a company, it's treated as an allowable expense, just like rent or salaries. It reduces the company's profit before that 24% tax is even calculated. Both are good, for sure, but the way they work financially is night and day.
So we've looked at the individual, the partnership, and the company. Now let's put it all on the table and see how these choices really stack up against each other.
You know, picking your business structure isn't just about paperwork or legal formalities. It's one of the most important strategic decisions you can make. It directly impacts how much risk you're exposed to, how much admin you have to do, and of course, your final tax bill.
Let's just boil this all down. Look at how different things are across the board. The taxable unit shifts from you to you and your partners to the company itself. The tax rate goes from a progressive ladder to a single flat rate. Even something as specific as Zakat is treated completely differently. Understanding these 4 key points right here is really the secret to making the smartest choice for your business. So, the bottom line is this. Your business structure is way more than just a box you tick on a form. It's a fundamental financial strategy. And remember, what works for you today might not be the best choice a year from now as your business evolves. So the question I want to leave you with is, are you sure you're making the wisest choice for where you are right now?